Hey folks, Tom Smith here. Why don't we go ahead and get started? Thanks for joining us. I am the full service broker here over at tradeMONSTER, and I execute a lot of the auto trades. Several years ago, what we started doing is we started comprising educational webinars and going to some of the top authors out there, trading champions such as Chuck Hughes, to bring exposure to people to start learning how to do option strategies from people that have done it and been successful in doing it. Chuck's a mainstay for us. He's been doing webinars for our attendees, clients, and prospecti people moving forward. I want to say for the last year and a half, Chuck, if I'm correct. And it's been nothing but great feedback from a lot of people that really want to learn on options, want somebody that's been there and done that. Chuck is great at that. Chuck, thanks again for joining us this month.
Yes, thanks, Tom. Thanks for the introduction. Can you hear me okay?
You sound great. I'm going to go ahead and pass the reins over to you. Why don't we go ahead and get started?
Okay.
And for those of you that do have questions, I know we're going to have a lot of them today, but we're going to be going fast and furious. We are going to have this archive, so feel free to put down the questions. I'll address them. If we don't get them back today, Chuck's support team can address them, or us at my tradeMONSTER can address them as well. So by all means, feel free to get a hold of us if you have any thing that needs to be communicated.
Okay, I'm just getting set up here. I'm going to put it into per slideshow mode. And can you see everything okay?
We're in good shape, Chuck.
Okay, great. All right, I want to thank Tom for taking the time to put on these educational webinars from everybody. As Tom mentioned, I've been doing it for some time, and it's a way for me to communicate the current trades that I've been taking in my own retirement accounts, and it's a great way for me to go through my thought process and kind of record everything so I can share it with you. So thanks again, Tom, for taking the time to put on these webinars. I enjoy doing them. Today we're going to talk about a low-risk strategy for trading stocks and options, and I've been very active with this strategy in my two retirement accounts, as you can see from the current trade results I'm going to show you. These are actual trade results in my retirement accounts using this low-risk option strategy, so you can see for yourself how well it's been doing in real time. So today we're going to look at a low-risk strategy for trading options, and in the second half we'll be looking at a low-risk strategy for trading stocks. And then, as Tom mentioned, we'll have a Q&A session at the end, and I'd be glad to answer any questions. So let's just talk about investing in options in general. When you purchase a call option on a stock, that call option is leveraged. And, of course, with that increase in leverage, that also increases your risk on a trade. So what I did is I copied and pasted a option chain for Home Depot stock, and at the time Home Depot was trading at 77.73, and so if you bought the at the money call, the 77.5 strike call, it would cost between $320 and $330. Got a $320 bid, $330 ask. So let's assume you were going to purchase this call option, at the money call option, when Home Depot was trading at 77.73. And what I did was I plugged in this trade into the call option purchase calculator, and the calculator will calculate the profit potential for this trade, assuming various price changes in Home Depot stock, in this example from a 10% increase in price to a 20% decrease in price. And we can see, but when we purchase this at-the-money call option, this is very high risk. If the stock remains flat at option expiration, we're going to experience a 92.9% loss. And if the stock is down, we're going to experience 100% loss. So this is the risk you take when you're trading options. So they're leveraged and they're also high risk. So you don't want to incur 100% loss of your capital when you're trading options. So I'm going to show you a strategy that can reduce the entry risk, and then if the trade is profitable, then we can adjust the trade and lock in that profit without limiting the upside potential. So this is a great way to trade options and reduce this risk level from incurring a 100% loss. So this is a price chart of the VIX, the volatility index, and you can see over the past year or so, each one of these spikes in the volatility index indicates a market sell-off. So if you're buying call options during this period, you could very easily experience a 100% loss based on this volatility. And these, again, each one of these volatility spikes is a market sell-off. So you could easily, if you purchased a call option, if you had bad timing, you could easily incur a 100% loss. So the trade selection process we're going to talk about now will help you find a low-risk entry, and this type of low-risk entry has been performing well during this type of market conditions. And I call this trade selection process the Prime Trade Select, three-step process for selecting high probability trades. And step one of Prime Trade Select is we want to determine the price trend first, and I'll show you how we do that. Step two is we want to confirm the price trend and determine the extent of the buying or selling pressure and isolate the very best trade opportunities. And step three is selecting a low-risk entry point using the Keltner Channels, and I'll show you how we do that. And this step three is important in selecting a low-risk entry point. And if you can get a low-risk entry point, then, of course, your odds and the probability of your success increases. So with step one, we want to determine the price trend of the stock or the ETF, and we use a trend following system to determine this price trend. I've been using this trend following system for many years, for more than 20 years, and it's been very successful in both bull and bear markets. Now, in general, with trend following, the goal is to quantitatively measure the buying and selling pressure of a stock, and trend following allows us to follow the trend instead of trying to predict the trend. And it allows us to use a system instead of using emotional decision making when we're trading. So a lot of advantages to trend following, and overall I think it's the best approach for the average trader is to use some kind of a trend following system to enter and exit trades. So we use the 50-day and 100-day exponential moving average systems to determine the price trend. And when the 50-day exponential moving average is above the 100-day exponential moving average, then that stock or ETF is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock's on a sell signal. And EMAs are similar to simple moving averages. EMAs are the average price of a stock over a specified period of time with more weight given to the most recent daily bars. So let's take a look at a trade that I currently have. This is for CIGNA, the insurance company, and I used Prime Trade Select to select this option trade. So here's a price chart, daily price chart for CIGNA, and these vertical lines are the daily open, high, low, and close. And you can see that CIGNA's been in a price uptrend, and this blue line right here is the 50-day exponential moving average line, and the red line is the 100-day exponential moving average line. So we can see back last September, the 50-day EMA, the blue line, crossed above the 100-day EMA. So at that point, CIGNA was on a buy signal. And as long as the 50-day EMA is above the 100-day EMA, then the stock remains on a buy signal. So we can see CIGNA's been in a very strong price uptrend, and I'm going to show you a method I use if I want to enter this trade after this buy signal occurs. There is a way to get a low-risk entry even though the stock has already made a really big price move. There is a low-risk way to enter a stock like this or an option after the stock's already made a big move, and I'm going to show you how we do that. So that's step one. We can see that CIGNA is on a buy signal because the 50-day EMA is above the 100-day EMA. Now, step two of Prime Trade Select is to confirm the price trend. And on any given day, there could be hundreds of stocks that are on a buy signal according to our trend following system. So we want to kind of narrow down that list to the stocks and options with the best profit potential. So we want to confirm that price trend. And one of the methods we used is called on-balance volume. And on-balance volume measures the volume flow with a single easy-to-read line, which I'll show you in a minute. And volume flow precedes price movement and helps sustain the price trend. So it's important to measure the volume in this price move of CIGNA stock. And I like to use the on-balance volume, and the on-balance volume line is calculated. It's a pretty simple calculation. When a stock closes up, volume is added to the line. When a stock closes down, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. Here again is the daily price chart of CIGNA stock, and on the lower half here we have the on-balance volume line, which is this line right here. And if this line is sloping up, it confirms this price uptrend, and it also tells us something about the sustainability of this price uptrend. In other words, you want to see an upsloping on-balance volume line because we know that that can help sustain this price uptrend. So it narrows down our list of buy signals by selecting only those stocks that have this upsloping on-balance volume line, and we know that the volume is there to sustain the trend. Another confirmation indicator we like to use is the new 52-week high list. And stocks that are making a new 52-week high are in a very powerful uptrend, and they tend to continue their price uptrend. So in my trading experience for over 28 years, I discovered that stocks that are making new 52-week highs, they tend to continue that price uptrend. And a stock that's making a new 52-week high confirms the price trend and allows us to further narrow down that buy list of stocks with the greatest profit potential. And here's a price chart again of CIGNA, and we can see that CIGNA has been making a series of new 52-week highs, confirming this price uptrend. And prime trade select step number 3 is selecting a low-risk entry point using the Keltner channels. And we saw from the previous slide that when you have a lot of price volatility, this is a very important step. So the goal with the Keltner channels is to find a low-risk entry point, and that increases our probability that the trade's going to be profitable. So the Keltner channels can help us time our trade entry and exit points. They also provide high probability buy and sell signals, and they can also be used to help select option strike prices. And another way to use these Keltner channels I found over the years is they allow us to select stocks with repetitive and predictive price patterns, and I'll show you some examples of that, and to avoid stocks that are not in a predictive price pattern. Here's a price chart of Home Depot, and this upper blue line right here is the upper Keltner channel. The middle line is the middle channel is this dotted line, and the lower blue line is the lower channel. And the Keltner channels basically act as an oversold, overbought condition. And what we want to do is we want to avoid buying the stock when the price is up near this upper channel, because that means that the stock is becoming overbought and the odds are it's going to correct. And the idea is to wait till the stock retraces back towards the middle channel or the lower channel before we buy, and that allows us to get a lower risk entry point. And I'll show you some examples of that I've used recently to trade options. So again, the Keltner channels act as an overbought, oversold indicator. When the price of the stock is up near this upper channel, the stock's becoming overbought, and you can see when it becomes overbought that it usually retraces back down to the middle or lower channel. Overbought, retraces back, overbought, retraces back, overbought, retraces back. So you can see that once it gets up near this upper channel, it's usually going to retrace back, and that's when we want to pull the trigger and enter our trade. So again, with the Keltner channels, we want to buy when the price drops near the middle or lower channel, and we want to either sell or don't buy when the stock becomes overbought and it's trading near this upper channel. Another useful way to use the Keltner channels is it allows us to focus on stocks that have a repetitive and predictive price pattern and to avoid stocks that have no clear trend. And what I did is I put a couple of examples here. This first one is a price chart of J&J, and we can see that this stock is in a very predictive price pattern, and the lower chart is of Alcoa, and we can see the price movement of Alcoa is all over the place. So it's really hard to profit when you're trading a stock like this. So we like to just focus on these types of stocks like J&J that have a very predictive price pattern. So that's another useful way to use the Keltner channels. We just want to focus on these stocks that are much more repetitive in their price movement and avoid stocks like this that have no clear trend. Here's another example. This is for Kellogg, very predictive price pattern. The lower price chart is for Freeport McMoran, and again we can see no clear trend with this stock, so we would avoid trading a stock like this because there's really no way to predict the future of that type of stock. Here's another example. This is for Whirlpool, very predictive price pattern versus Potash, which has a lot of rallies and sell-offs, no clear trend. So let's look at an option trade I took recently using the Prime Trade Select. And this is a daily price chart of CIGNA. And again, we can see it's been in a very strong price movement. So the question is, how do you enter this stock or option and get a low-risk entry after the stock has made such a big move? So what I did was I waited till CIGNA retraced towards this lower Keltner channel in early June, and I went ahead and purchased a call option on CIGNA once it retraced here, trying to get a low-risk entry. And here's my brokerage confirmation shows that I bought to open the CIGNA 50-strike call option right in here at 17 points. So this enabled me to, using these Keltner channels, enabled me to find a low-risk entry, even though CIGNA has already had a large price move. So right in here, I purchased the 50-strike call option. So with CIGNA, at the time, CIGNA stock was trading at 66.71. So purchasing the 50-strike call was an in-the-money call because the 50-strike price was less than the current stock price. So this would be an example of purchasing an in-the-money call. And the reason I selected this call was this has high intrinsic value and very low time value. And what I did was I plugged this option trade into the call option purchase calculator, and this calculates the profit potential for this trade, assuming various price changes in CIGNA stock at option expiration, from a 10% increase to a 10% decline. And this call option purchase calculator also calculates the time value, and in this trade it was 29 cents, and the intrinsic value was $16.71. So whenever you purchase an option, you want to maximize this intrinsic value and minimize the time value, because at option expiration, options lose all of their time value. So options are a decaying asset, and they slowly lose their time value, and at option expiration, this time value goes to zero. So we want to minimize this time value, and that allows us to find a lower risk trade. And let's look at the break even on this trade. With 0.29 points of time value, or 29 cents, CIGNA stock only has to increase 29 cents or 0.4% for this trade to break even. So that's why looking at this time value is so important, because with this trade, it only has to increase 0.4% for this trade to break even, and then any increase above that break-even point will result in a profit for this trade. So whenever you purchase an option, just keep in mind that you have decaying time value, so you want to minimize that time value. So the intrinsic value of an option increases 1 point for each point increase in the stock price above the strike price of the option. So in this case, it was the 50-strike call option. So any increase in the stock price above 50 results in a 1 point increase in the intrinsic value. So I'd much rather take a trade that only has 0.4% increase in the stock price to break even compared to, say, a 10 to 20% increase in the stock price to break even for an at-the-money or an out-of-the-money strike price. So when you select these in-the-money calls, you have a much higher probability of success, because the stock only has to go up 0.4% for the trade to start profiting. So these in-the-money call purchases have a much higher probability of success. So I was able to get a low-risk entry for this CIGNA 50-strike call option, and the trade turned into a profitable trade. So once I had a profit in the trade, then I had to decide whether to hold the trade for further upside profit potential or to take profits in case the stock declined in price, with the possibility of the trade turning into a total loss. So whenever you trade options, you always have to make this decision. If the trade is profitable, you find a low-risk entry like I did using the Keltner channels, then you have to decide, well, do I sell the option and take my profits in case the stock declines in price, and I don't want my profit to turn into a loss. But by selling the option, you also limit any further upside profit potential that that stock may have or that option may have. So this is the dilemma you always face when you're trading options. So what I did in this case was I bought the CIGNA 72.5 strike put option at 142, and this created a market neutral spread. So instead of selling my call option, my 50 strike call option, and taking profits, I bought a put option to protect those profits. And this allowed me to lock in a profit for this trade no matter what happens to the price of CIGNA stock, but at the same time my upside profit potential was not limited. So this is a way to lock in a profit on an option trade and still profit if that stock continues to go up. So this allows you to avoid that decision of whether you should sell or not, because you're locking in a profit, and at the same time you continue to profit if the stock increases in price. So my brokerage confirmations show that bought the 50 strike call at 17, that this trade was profitable. So at a later date, I bought the 72.5 strike put at 142. So what I did was I input these prices into the market neutral calculator, and this will calculate the profit potential for this market neutral spread at option expiration, assuming various price changes in CIGNA stock at option expiration. So again, I bought the 50 strike call at 17, bought the 72.5 strike put at 142. And we can see that as the price moves up, or as the stock moves up in price, you can see here this bottom row is the percent return potential for this trade. So we can see as the stock price moves up that the return potential goes from 43% if the stock is flat to 84% to 126. So the profit potential is not capped with this market neutral spread. And this will also make money if the stock starts to decline. This market neutral spread can also make money if the stock declines substantially. We can still profit on this spread. And once I purchased that 72.5 strike put, then I locked in a profit on my current option trade, and we can see that the minimum I would make on this trade would be 22%, no matter what happens to the price of CIGNA stock. So creating the market neutral spread allowed me to lock in this profit no matter what happens to the stock, and at the same time I'm not capping my upside potential with the trade. And again, if the stock is flat at option expiration, I get a 43% return, and if the stock increases 10%, I get an 84% return. So it's a way to continue to participate in the up move in CIGNA stock, and at the same time we're locking in profits in case the stock declines. So with this type of strategy, it's very stress-free. We don't have to worry about protective stops, bad earnings reports, or big down moves in the stock, because we're protected once we buy this put option. And I'll look at another example here real quickly. This is for Best Buy, and this is a daily price chart of Best Buy, and we can see in late June, the stock dipped down towards the lower Keltner channel, and this presented a good buying opportunity. So I went ahead and bought the Best Buy 20 strike call at 664. So my brokerage confirmation here shows that I bought 2 of the Best Buy August 20 strike calls at 664. This was back at the end of June, right here when the stock dropped towards that lower Keltner channel. And so at the end of June, I bought the August 20 strike calls at 664. So this, even though Best Buy, as you can see, has made a large price move, this allowed a low risk entry to participate in any further upside with Best Buy. So my low risk entry for the 20 strike call option was successful, and the trade was profitable. So then again, I had to decide whether to hold the trade for further upside potential or take profits in case the stock declined in price. So again, I elected to create a market neutral spread, and I bought the Best Buy 30 strike put at 150. And this was a couple weeks after I had purchased the call. I went ahead and purchased the put option at 150. And this allowed me to lock in a profit on the trade regardless of which way Best Buy stock traded, and at the same time my upside profit potential was not capped. So as Best Buy stock moves up in price, my profit potential increases. And again, I used a market neutral calculator to calculate the profit loss potential for this market neutral trade, assuming various price changes in Best Buy stock. And again, this allowed me to lock in a 22.9% profit no matter which way the stock traded. If the stock was flat, I'd have a 23% return. If the stock increases 10%, I have a 60% return. So as the stock moves up in price, my profit potential also increases. And if the stock moves down substantially, I can also profit from this trade. So again, initiating the market neutral spread by purchasing the put option allowed me to lock in a profit and also continue to participate in any profit potential from the underlying stock. And again, I don't have to worry with this trade. I don't have to worry about protective stops, bad earnings reports, or big down moves in the stocks. I simply bought the put option, locked in my profit, and then I just wait till option expiration, and then I have a guaranteed profit. Here's another example. This is for Hewlett-Packard, and we can see at the end of June, the stock dipped towards a lower Keltner channel, setting up a good buying opportunity. So I went ahead and bought the 18 strike call at 555, and then 2 weeks later, this trade had a profit in it. So 2 weeks later, I bought the 26 strike put at $1, and again, this allowed me to lock in a profit on the Hewlett-Packard option trade and still participate in any up move in Hewlett-Packard. So this is a great way to trade options. We want to find a low-risk entry point using the Keltner channels, and if we get a profit in the trade, then we want to buy a put option to lock in a profit and also continue to participate in the potential profit potential if the stock continues to move up in price. So I make trade recommendations for this market neutral spread strategy with my advisory service, and I took a snapshot of the trades in the current trades in the portfolio, and this table lists our entry price for the call, the entry price for the put, and this is updated real time every day, and we can see that the profit, dollar profit for each trade, and then the percent return. And this was a snapshot we took recently, and the total profits on these trades was $138,429, and we had an average return of 316%. So what we're doing is, if we have a profit on an existing option trade, then we'll go ahead and buy a put option to lock in our profit with the trade, and at the same time we continue to participate if these stocks continue to move up in price. So this is a great way to trade options, and even in the unlikely event all these stocks had big down moves, we would still profit with this strategy. So this is a great way to trade options. And if you're interested in the market neutral spread strategy, just log on to weeklyoptionalert.com and click trade results, and you can see the most current trade results for the market neutral strategy. So now we're going to move on, and we're going to talk about a low risk strategy for trading stocks, and I'm going to show you some actual trade examples in my retirement accounts using this strategy. So again, we want to use the Prime Trade Select three-step process for selecting high probability stock trades. And again, step one is we determine the price trend. Step two, we confirm the price trend and then determine the extent of the buying and selling pressure, and then we isolate the very best profit opportunities. And then step three is to select a low-risk entry point using the Keltner Channels. And this step three of finding a low-risk entry point is important. And again, with the current market conditions, we can see each one of these spikes in the volatility index here represents a market sell-off. So what we want to do is find, with step three of Prime Trade Select, we want to find a low-risk entry point so we can avoid being stopped out if the market declines. So if you're buying a stock in these types of market conditions, you can easily get stopped out of your position if your timing is not good. So we want to find a low-risk entry when we buy a stock or an ETF in these types of market conditions, and the best way to do that is to use these Keltner channels to set up a low-risk entry. So with Prime Trade Select, if we have a buy signal, we'll purchase stocks or ETFs. We purchase call options. We purchase bullish option spreads and also market neutral spreads. And if we get a sell signal with Prime Trade Select, we purchase put options. We can purchase option spreads and then purchase bearish ETFs or market neutral spreads with sell signals. And I'm just showing a snapshot now of my two retirement accounts, and I use Prime Trade Select to select the trades in these two accounts, and I have over $508,000 in actual profits, average return of 73.2%. So in my first retirement account, I have over $365,000 in profits. These are the stock and ETF positions here, and these are the option positions in that retirement account number one. And then in retirement account number two, I have over $142,000 in profit. So over $508,000 in profits in my 2 retirement accounts. So you can see that the Prime Trade Select is working well. So let's look at a trade I took recently, a stock trade. Actually, this was an ETF trade, and this is for the leveraged financial ETF. And we can see from this price chart that the leveraged financial ETF, symbol FAS, is in a price uptrend. The 50-day EMA, the blue line here, is above the 100-day EMA, so we're on a buy signal. We can see an upsloping on balance volume line confirming this. And back in November of last year, I purchased the this FAS leveraged ETF, and I was able to get a low risk entry. You can see how far it's moved since in November. I bought it in the $35 range, and it's trading at around $75 today. So it's more than doubled since last November. So this, using the Prime Trade Select and the Keltner Channels, I was able to find a low-risk entry, and the trade has really worked out well. So again, I'm faced with this dilemma. The trade's worked well. Do I sell the stock and take profits? But if I do that, then I won't participate in any further up moves in the FAS. So again, I was faced with that situation. So I went ahead recently and purchased the 70 strike put at 590. So back last November, I bought 200 shares of the FAS at 106.50, and this ETF had a 3-for-1 stock split. So my split adjusted price for the 600 shares, so this 200 shares turned into 600 shares, and my split adjusted price was $35.50. So I have a huge profit in this, and the question is, do I want to sell the shares in case the FAS declines in price? But if I sell the shares, then again, I'm not participating in any further up move. So I elected to purchase 3 of the 70 strike puts at 590. So with this purchase, split adjusted, I have 600 shares. So I'm writing weekly covered calls against 300 of these shares, and I purchased 3 of the 70 strike puts at 590. These were the October 70 strike puts. So I have about a little more than 3 months of protection in case FAS goes down in price. And by buying these puts, it's just like the market neutral spread. By buying these puts, I lock in my profit on the stock, and I don't have to worry about any big down moves because I've already locked in the profit by purchasing these puts. But if the ETF continues to go up in price, I continue to profit. So it doesn't limit my upside profit potential. So buying these puts on the ETF that I already own, this creates what's called a married put spread trade. And again, the married put locked in a profit for the trade, and at the same time, it did not limit my upside profit potential. And I have a married put calculator, and I input the entry price for the stock, $35.50, and I purchased the 70 strike put at 590. And the married put calculator will calculate the profit potential for this trade, assuming various price changes in the ETF at option expiration. And in this case, it's from 150% increase to a total loss in the stock, in the underlying stock. And with the leveraged ETF, of course, I use bigger numbers in this column because I already have a about an 86% return on this trade. So with the married put spread, the profit potential is not capped. As the ETF moves up in price, the profit potential increases. And we can see as the ETF moves up, the profit potential moves up. And it allowed me to lock in a guaranteed profit of 72.8%. And if the stock is flat, I have a 72.8% return. So with the FAS currently trading at 75.67, I have about an 86.7% return on this trade. And again, I locked in a 72% return no matter what happens to the underlying ETF. So again, with this type of trade, I don't have to worry about protective stops or big down moves. I also purchased the small cap ETF, leveraged ETF, symbol TNA, last November when it declined, and that set up a low risk entry point. I purchased it around the $27.50 level, and we can see with the TNA trading at 59, again, I have a very large profit in this ETF. So I elected to purchase put options, October put options that will lock in a profit for this trade no matter what happens to the underlying TNA ETF. And again, at the same time, my upside profit potential is not limited. And I also make married put trade recommendations for my advisory service, and this is showing the current profits for each of these married put trades. This shows the stock or the ETF and the put option that we purchased. These prices are updated every day, and this column shows that we have total open trade profits of $115,000, and we have an average return of 67%. So that's a pretty good return for such a low-risk strategy. Okay, that concludes my presentation for today. And if you're interested in the advisory service, you can call Brad at this toll-free number, or just log on to weeklyoptionalert.com, click trade results, and you can see the current profit results for the various strategies that we trade. So that concludes my presentation, and I'd be glad to take any questions.
Updates to our website, wqc.com. And you can find more information on this year's RAGBRAI at ragbrai.com. There's also a link on our website. And looking ahead to future rides, the Scott County Board of Supervisors will vote tonight on supporting a plan to bring RAGBRAI.
Chuck, I do have a question for you.
Yeah.
From Brian Dom, he's asking us how do you determine how many option contracts you buy? And if you're using an IRA, would you use a set dollar denomination or percentage denomination for each trade?
Yeah, that's a great question. And I try to trade a lot of different types of strategies in my retirement accounts, and one of them is the option purchase strategy that we looked at earlier. And because that's a higher risk strategy, I like to limit that to 10% of my retirement funds. Now, limiting it to 10% doesn't mean I can't get a good return, because I have gotten a good return because the options are so leveraged. But just to reduce the risk in my portfolio, I limit that to 10% of my total portfolio. And then I also trade the market neutral spreads. I trade the weekly covered calls, and I trade the monthly covered calls. So I like to spread out the risk amongst various strategies. But the option purchase strategy, that's the one strategy that I'll limit my total exposure to 10%, because it is a retirement account and I want to keep my risk low. But I can still get a good return just limiting it to 10% of my total portfolio.
Chuck, we have a lot of questions, and I apologize. We went a little long today, so we're not going to be able to ask Chuck too many questions, but feel free to pick up that phone, contact Brad. His support staff's really good about addressing questions correlated to Chuck's program and his strategies. We ran a little short this week, Chuck, but I want to thank you for coming out again. I'm going to go ahead and take the reins. And those of you who weren't able to keep up, I know Chuck covered a lot of material today, but we'll have this archived tomorrow afternoon on mytrademonster.com. I have it posted here. If you click on free education or just go on the right-hand side of the page of webinar archives, I'll have Chuck's webinar that he did today listed under the month of July. Chuck has been kind enough to do webinars with us every single month, and he allows us to keep these archived. So you can go back, you can review them, you can download them, contact Chuck's support staff, ask questions. Feel free to call us at My Trade Monster, ask us questions. It's a great time of the year, especially since we're coming into the fall here. We're in the middle of the summer. Chuck, do you see this as a viable opportunity to really start getting your toes wet in the markets?
Yes, I do, Tom, especially with the market neutral strategy that really limits your downside risk. So, yeah, this is a good opportunity to start positioning into those sectors that have been performing very well, like the financial sector.
Yeah, well, there you have it. So for those of you that are looking for more education, a little bit of an edge, Chuck's program can obviously offer that for you. Chuck, I hope we can invite you out again next month for another webinar.
Yes, definitely, Tom. Looking forward to it. And again, I want to thank you for taking the time to set up these educational webinars. And I think a lot of people benefit from these, and we appreciate that.
Yeah, I do as well. And for all the attendees, if you do have questions regarding trading, your IRAs, corporate accounts, hedging, leveraging, Chuck's program is a great way to start, but feel free to contact us here at TradeMonster, and we're happy to address any questions. Thank everybody for attending tonight. Chuck, thank you as well, and I hope everyone has a nice weekend.
Okay, great. Thanks, Tom. Good night, everybody.
Good night, everybody.